Since we're going to be talking about Uber,
Yeah.
do you have any crazy Uber stories?
Did I actually tell you that I used to drive for Uber?
No.
Yes, I did.
Oh, okay.
Yes.
Moonlighting as an Uber driver.
Yes, I had put my car. I still have an Uber driver's account.
Okay.
Yeah, but So I used to drive for Uber.
Okay.
That was one. It's many years ago. I'm trying to remember because it was perhaps has to be 2016 or 2017.
Ah.
And so I put one of my cars. Okay, when I say one of my cars, I was running a car hire business on the side.
Yeah,
So I had a couple of cars. Yeah.
Big guy. Kuba.
Well, it was really like just trying to see if I can make a bit of money on the side.
Okay.
But it was one of the most stressful businesses I've ever run. So I put one of my cars on Uber.
Mm-hmm.
It was the one that I was using mostly.
Okay.
So on weekends or randomly after work, I would put on the app so that I can start accepting rides just after work. Like sometimes I'd work until 8 p.m. Then I'll put on the app and start accepting rides. So one day I put the app on. Now, I used to live on this other side of town, which is Kabete area. And it gave me a trip that was going to some place called Syokimau on the extreme end at night.
Okay.
Yeah, so I drove. There was a bit of traffic. When I got there, that time I had not. When I put the app on, I had not set the destination because sometimes it gave you the option to set the destination where you're going, so that it gives you trip largely towards that direction.
Okay.
Yeah, so I went to Syokimau. As I was dropping, another trip came. I accepted.
Where was that one going?
I was going past Kitengela on your way to Namanga.
Wow.
Towards Tanzanian border.
So you just kept...
Yeah, I did the trip. Long and short is that I got home at about 1 a.m.
Wow.
And I started reconsidering this side hustle. I got home at about 1 a.m. and tomorrow I have to wake up at 5, get ready.
And you were almost in Tanzania.
Yeah, exactly. So when I got home, I sat down and asked myself whether I really wanted to continue with this side hustle. So yeah.
Wow.
I have a story of driving for Uber.
Wow, that's so
Uber,
cool.
Yeah,
Tim, you've led very many different lives, huh?
Yes, I have.
That's so funny. I don't have any cool stories like that. Me, I've only ever been on the person calling the Uber. I've only been on that side.
Yeah.
I don't know. It's just always just the audacity. That's what usually strikes me.
Yeah.
So especially here in Kenya, it's mostly you call the guy.
Uh-huh.
Usually it's a guy, you hail a person.
Yeah.
They accept.
Mm-hmm.
And they start texting you, hi. Where are you going?
Where are you going? Where are you? Exactly. Yeah.
And I'm like, bro, I'm going to this place. Sometimes they're like, oh, that's too far. I can't.
Mm-hmm.
What really upsets me a lot is when they accept the thing, especially when I'm in a hurry. They accept it.
Mm-hmm.
And then they say, oh, that's far. Oh, I am not going that way.
Mm-hmm.
And I'm like, but you're the one who put in, now that especially that I know that you can even set the destination.
Exactly.
So you're the one who accepted.
I don't know whether it still works.
I don't know.
It was a while ago because I know you could set destination as a driver. You could say,
I'm going in this direction.
I'm going this direction.
Yeah.
I'm going to Westlands. So you get trips closer to Westlands as opposed to perhaps getting a trip to the airport.
Which, and I understand.
I don't know whether it still works that way.
If it's taking you very far, I get it. But also, if that's the case, I expect you as the driver to be the one to cancel the ride. Because I opted that I wanted to go. You said yes.
Yeah.
And now because you can't take me, I think you should be the one to cancel. But a lot of the times, they're like, no, you cancel. Then we have this standoff where we're both waiting for the other to cancel.
Exactly. And mostly they don't want to cancel.
Yeah.
So they're waiting for you. You're stuck. You can place another order.
The days when I'm not in a rush, I'm like, you found me when I have time.
Yeah.
So I'll sit. The days when I used to be at the office and it's like, okay, 6 p.m., whatever, I'm about to head home.
Yeah.
And I'm chill. Like if I get home at 6:30 or 6:45, whatever.
Yeah.
So I wait. The guy is not canceling. I'm not canceling. I'm like, cancel. He's like,
yeah.
Then I call a different, like have another app.
Yeah.
You Little or Bolt or whatever.
Yeah. And you proceed. You go home.
And I'm still waiting. I'm like, when's this guy going to cancel?
Hello and welcome to episode 9 of the Full Scale Podcast. I am Timothy Mokiti. I'm joined by my friend and colleague here, Adrian Twatwa. In this particular episode, we will be reviewing a particular deal. So we would want, in the previous episodes, we have considered various items in the journey of a startup, including formation of a startup, the founders and why the founders are important, what is a startup, fundraising for a startup, investing in a startup, scaling up, regulatory compliance, and the series of fundraising that a startup makes. Now, we would want to bring that to life. And the episode that we're doing today, we're going to be considering a particular deal that has been completed between Moove and Uber. And we will give you a little bit more details on that. But even as we go into Moove, the transaction between Moove and Uber, we'll equally review the transaction from way earlier. Not the transaction, really. We'll review Moove from way earlier, from founding to a couple of series of fundraising and valuation, including, considering their founders. So perhaps this will help us bring to life the deal making as well as the parties to a deal.
Yeah.
So, Adrian, I hope you're excited about this one.
Yeah, I am. Actually very excited about this episode because, as you said, it's sort of going to bring to life many of the concepts that we've gone over. Like, we've been speaking about this, I think, from a pure, mostly theoretical level, or sort of in the abstract. We've given a few examples along the way. Mm-hmm. But I think this will be a good case study just to show from the time this startup was thought of as an idea up until the recent deal that they've entered into with Uber and other investors. There's been a lot of work that's happened, and a lot of the things that we've talked about, the insights that we've spoken about throughout the previous episodes, I think a lot of it is reflected in the journey that this startup has gone through. So I'm pretty excited to get into it. We're calling it Deconstructing the Deal.
Exactly. We are calling this episode Deconstructing the Deal, and we are taking a deep dive. So most of the information actually that we will share with our audience comes from what we can gain from public sources. Or authorized sources. So I think it's important to let our audience know that
we were not involved in this deal.
We were not involved in this deal, but we have studied the deal from public sources as well as sources that are available to us through subscription.
True, correct. Exactly. So we don't have any sort of confidential information. We were not advisors on the deal or anything like that. So everything we're saying, you can look this up and make sure that you can see it. Yeah, it's all online for you to access. So
Yeah, so before we go into the growth map and the journey of Moove, perhaps you can let us know a bit about the founders.
Yeah, sure.
Moove.
I think that's a good place to start. We started episode 2 after our intro. Episode 2 was about the founders. What's a founder? What's a startup? So who is the founder in this case, and what's the startup? So the startup is Moove. So the founders are 2 British-born Nigerians. They're named Ladi Delano and Jide Odunsi. They co-founded Moove in 2020. Moove is Moove. Well, I guess if you're watching this on YouTube, you'll see it. If you're listening on podcasts, you'll see this in the description of the episode. But it's Moove. They are, pretty impressive guys. They have degrees from, great institutions. One of them went to Oxford. They both went to London School of Economics. They're both alums of London School of Economics and MIT Sloan for one of them. Odunsi worked as an investment banker at Goldman Sachs, management consultant at McKinsey. I think they reconnected after a while. They parted ways in their teens. So I guess they knew each other early on in their lives. And then they reconnected to run a venture studio. They came together, started a venture studio, and I think they ran a few other businesses before they actually turned to Moove. So I guess seeing the importance of the founders seem to know each other. They seem to trust one another. They had built things together in the past. This wasn't their first startup. So it sounds like they had grit. They kept going at this and looking for the right idea that would fit for them and that worked for them. And yeah, so I guess just going back to episode 2, right? Who is a founder? It's people who've come together. They have this idea, they have conviction, and they're willing to pursue this thing all the way through, which looks like they're, well in the midst of doing just that. So those are the founders. That's sort of a high level description of their background. So maybe we'll talk about the idea, Tim. So what's the idea with Moove? Like, what is the idea and how did that start?
So the idea for Moove started when the founders considered that there's a serious gap between vehicle financing in Africa and other jurisdictions, other parts of the world.
Okay.
Especially the key contrast for and this is the data that we have available to us. The key contrast that motivated their idea was the stark contrast between the number of new car sales sold in Africa and the number that is sold in the US.
Okay.
And the particular reason around this was the lack of vehicle financing across the continent. So their concept actually is around financing for vehicle acquisition.
Okay.
So they sought to address a gap in response to the challenge faced by over 2 million African mobility entrepreneurs in terms of accessing vehicles.
Okay.
Because
what's a mobility entrepreneur?
A mobility entrepreneur is an entrepreneur in the space of moving either people or goods or delivery.
Okay.
So basically mobility, moving. Yeah. So basically there was a challenge faced by over 2 million African mobility entrepreneurs, especially in terms of acquiring the vehicles or the mode of delivering or ferrying their passengers around.
Okay.
So Moove was initially founded to solve this need in Lagos, solve that problem in Lagos of access to financing to get mobility vehicles. Yeah.
Okay.
But it has since expanded to 6 cities in Africa. And their model is basically around democratizing vehicle ownership in Africa by providing revenue-based vehicle financing to mobility entrepreneurs.
Okay.
So this is basically, actually that goes to their moat, revenue-based vehicle financing. And we discussed what moat is in our episode 2.
Correct.
What is a moat and what is your edge?
Yeah.
So they, and we will discuss in more detail what really they developed around around that. So that's by and large the idea, to basically solve mobility, access to financing to acquire for mobility entrepreneurs in the African continent, and especially starting from Lagos, to be able to acquire vehicles for purposes of undertaking their business in the African continent. Yes.
So it sounds like I'm a mobility entrepreneur. Like I've woken up today and, like Tim many years ago, I've decided I want to drive Uber. I want to drive around for
I was
Uber.
a mobility entrepreneur,
Yeah,
bootstrapping. Yeah.
And I want to use my car as a source of revenue, right? I'll go around, drive people, and I'll collect revenue through that. The issue being, getting a car is not as easy. Financing the purchase of a vehicle is not as easy on the continent as it was in the US or other jurisdictions that they looked at. So I know in the US, for example, you can go to a car dealership and they'll offer you a financing right there. I mean, they'll look at your credit history and all of that, and they can lease the car to you. So you're paying down the lease.
Yeah.
Or you can actually get a loan for the car and you can pay that down. So it's a lot more readily accessible, as opposed to here, where I don't think that's really the case, at least based on the statistics that they looked at and based on the data they looked at. So, but it seems like the idea wasn't just for anyone who's looking for a car, right? It's specifically people who are looking for a car in order to generate revenue from that car.
Exactly.
So it seems like they targeted something niche, even within the problem set that they looked at, or the people who are affected by this issue. They looked at specifically the people who are trying to get the car, not just for vibes, but actually to get money through this vehicle.
People get cars for vibes, yeah?
Hey, I don't know. Tell us. You have a nice Subaru. Tell us.
Anyway, so
I'm a mobility entrepreneur. I'm looking for a new car.
Yep.
In order to go about financing or to go about creating revenue. What Moove does is Moove brings me on board. They first of all, they vet me. Then after I've been vetted and trained, we then enter into a contract. That contract is for a loan. The loan is given to me as an individual, and the car is basically kind of the collateral for that loan.
Yeah.
So I receive this loan to then pay for the car, and then I pay down this loan over time. So as I drive around and I collect people to go to Kitengela and all these far places, I receive money, and a portion of the proceeds from that trip go towards paying down the loan. Over time, I think these loans range from anywhere from 24 months to 48 months. Yeah. So over that course of time, I'll pay back that loan. And once I pay down the loan, then the car is fully mine and I own the car. And I think Moove specializes specifically in new cars, because I know there's a lot of secondhand vehicles on the roads here
in the market.
But specifically getting financing for a new car, I don't think is as easy to come by. So they really are bridging that gap. And specifically also once you've onboarded and they've given you the loan and they've helped you finance your acquisition of the car, they then onboard you onto the Uber platform so that you directly have that source of income through Uber. So Uber and them have partnered to create this synergy where you get your loan through Moove and then Uber onboards you get the car. It's sort of like a whole ecosystem.
Yeah. And the beauty about it is in terms of looking at it from a commercial sense, is that you get the benefit of having access to a pool of customers through the Uber platform. So it's a win-win for both sides. Yeah. So Moove gets to know that you will have the consistency to repay the loan.
Right.
On the other side, the financing, On the other side, Uber has drivers that they know will be able to, help it expand its business reach in terms of ferrying passengers. Yeah,
I think there are many unique ways about this that work quite well. Also, in terms of the rates for the loans. Yeah. So I think the interest rates for loans from Moove range from 8 to 13% annual interest. Yeah. Which compared to at the time in Lagos, banks were charging anywhere between 20 to 25% interest.
Exactly.
So you can imagine I could go to a brick and mortar traditional lender and get a loan for 20%. Yeah. Or I could go through this company. They're a startup, they're flexible, they're nimble. They give me 8 to 13% annual interest. I get the car. The revenues are going directly to paying the car. It's also flexible in that depending on how much revenue you're making, it could also adjust the amount that you need to repay in terms of loans. Yeah. So I think that also reduces the risk of default because the people you're giving loans to are using it to access an asset that's going to generate money, and that money portion of that is going to go towards paying you. So I think there are many really cool ways that they thought about this and that play out in a way that's quite innovative. Yeah, indeed. So maybe that's answered the question and why this is an innovative idea, or do you want to go into a bit more in that?
Well, part of the reason why this is an innovative idea is that they use an alternative credit scoring technology that enables them to underwrite the loans, based on the driver's revenue streams.
Okay, do you want to unpack that?
Yeah. So they're able to review the revenue streams of the driver. Okay. And after reviewing the revenue streams of the driver, they can use that to basically determine how much loan you can access and how much financing you can access for purposes of acquiring a vehicle for undertaking the business.
Yeah, how much of a risk you
exactly
are,
right? How much of a risk you are, and the fact that you're going to generate revenue. How much do you generate on average, and which then determines how much they're going to finance you. Okay. So actually, it's the innovation now is around that alternative credit scoring technology.
It's also, I guess, just to note that we don't know all the elements, of course, that go into their alternative credit scoring because it's proprietary knowledge, right? It's proprietary information. However, it is that they've come up with and conceived of a way of scoring a person to whom they're going to lend money. We don't have insight into all the things that work out. Exactly. It was sort of that bear out in that formula. And that's also key to their success, right? It's that they have come up with a way that they believe can score you quite well and determine how risky you're going to be, and therefore determine whether they lend to you, how much they're going to lend to you. And that means they're hopefully also going to make more returns on those loans, because the people that they've lent to are more likely to repay those loans, more likely to repay with the interest. And so it sort of becomes a virtuous cycle, right? You can get people who can pay loans, you can give them the loans, they can make money comes back in, and so on and so forth. You mentioned the concept of a moat. So maybe I'll just delve a little deeper into what it is that what
you understand to be their
moat, right? So we talked about a moat being a defensible position that makes you stand out from your competition, right? So that even if they try to replicate your business model, it's quite tough for them to get there and to steal your market share or to earn your market share, because you've already carved out such a strong position in the market. So it is that proprietary credit scoring technology for sure, which we've spoken about. I think one thing that I would note is also, I think, the caliber of the founders. I don't think, they're two, it sounds like impressive individuals who have done this before. They've run other companies, they ran a venture studio. So finding those types of founders who have that pedigree and that have that conviction to keep going forward and building businesses, I think that's really strong, because not many other businesses have those types of founders. So finding the right types of founders in the right type of business is also key. So that's part of their moat. I think the partnerships and investments that they've obtained, which we're going to go into the investments and such later, but if you talk about just a partnership with Uber, even so early on, being able to have credit scoring technology and loans that you can finance for cars and all of this is great. But if your riders receive those loans and then they don't have a platform to go use to generate income or revenue, that's a bit of a challenge. So having that partnership with Uber, where it's very seamless, once you get on Moove's platform and you have the loan, you then are onboarded onto Uber. I think that was really huge for them. So even if a competitor comes into the market now with a very similar system and platform, they might not have that Uber partnership, right? So it would be a bit of a struggle for them to catch up to where Moove is now.
Exactly. And maybe to add onto that, on the question of moat, like you've mentioned before, and I'm just looking at data from PitchBooks. So there are comparisons. The businesses that are being compared to, that Moove is being compared to, are MNT Investments, Jumo, and Tugende. And I'll let you know what this particular business is. So MNT Investments is based in Giza, Egypt. Okay. And they provide financial services intended to serve commercial and retail clients. Okay. Jumo is based, it's a financial software business that is based in London, United Kingdom, And the business, what they offer is they develop an ultra-lean banking technology designed to deliver progressive financial choices to customers in emerging markets across Africa and Asia. Then we have Tugende, which is based in Kampala, Uganda, which is in the consumer finance sector. And they provide financial services intended to tackle credit gap for small and medium-sized businesses. Now, going back to that thing about the concept of moat, you can see that comparable businesses are doing something similar, but they're not exactly in the same sector. Correct. Which could also be buttress their position in terms of a moat. Like, you could be using comparable technology or comparable maybe data sort of, but the market that you're serving is so niche, because I don't think any of these other comparable businesses would perhaps raise capital from Uber, because there's no strategic sort of much between the businesses. Tugende is a bit closer, because I think they also lease for hire or lease to own. So you can lease the bike from them. I think they focus more on motorbikes in terms of sort of boda, that type of thing. So even within then, I guess they're focused on a different vehicle type as opposed to what these guys are focusing on. So again, there's differentiation there. There's more of a niche focus, which I think that's a great point. So the more focused your market is, a niche, even if people are offering something similar, they might be offering it to different people in other sectors and might not be serving that specific client base as well as you are. Exactly. You could be having almost close to similar models. but the fact that you're serving a totally different market, that even helps you with your niche.
Correct.
I could perhaps give an example of if you're doing e-mobility. And e-mobility, we mean electrified mobility. You could do it in buses, which means you're targeting public transport in buses, mass movement. You could do it in e-bikes.
Yeah.
And the challenges or the business model of somebody who is doing, who is in the business of e-bikes, maybe cycling bikes that are electrified,
Yeah.
is not the same as one who is running it for purposes of mass transport. You know, you're doing it for buses. So that in itself, going, because e-mobility is very broad, it's quite broad. But when you go a little deeper and go niche, then perhaps it helps you buttress your moat.
100%. And I think also the fact that the people they're targeting, being mobility entrepreneurs, specifically focused on financing this vehicle to make money. I think that's also a portion of their moat, in that you could be out there trying to finance people to get vehicles, but the people who are going to get those vehicles, are you sure that they're going to repay, right? It's, I think, a bit more closely aligned to your interest if they're actually getting the car to make money, because then they'll use that money hopefully to repay the very loan that you gave them, which
is capital you're providing them for their business. It's a form of capital.
And of course the revenue-based repayment model, right? Which means you can adjust the payments being made by these mobility entrepreneurs based on the actual earnings that they're making, which I think is also really cool and offers flexibility. Because you might go to another lender and they might not offer you any flexibility. They might say, I don't care if you make 100,000 shillings this month or you make no shillings this month, the payment still remains the same. So having some sort of flexibility based on how much revenue you make, I think is pretty cool as well. So I think all those elements sort of contribute to what makes this business different from anyone else that's doing mobility in the same sector or even in the same region, and contributes to them having a more defensible moat or a defensible position in the market. Do you want to discuss a little bit about their formation? So we talked about the idea, we talked about the founders. So they've come together, they have this idea, they know who they are as the founders, they know their strengths. So now they've decided to go off and form the entity to do this. So they formed, it's a limited company which is registered in Amsterdam. They're headquartered in Amsterdam. It's called Moove Vehicle Limited. So we spoke about limited liability. So to that point, that's probably why they went with a limited company, so that the shareholders have limited liability when it comes to the liabilities and obligations of the company. Headquartered in Amsterdam, perhaps, I mean, of course, we don't know them personally, so we haven't asked them these questions, but we would assume it has to do with sort of your funding, where you're going to get your funding from. It sort of opens it gives you a broader scope of investors that could come in if you're in a jurisdiction that they're familiar with. So perhaps Amsterdam is something that they considered that when they were choosing that as a location. So they formed the entity. They're now going about, starting the business. We talked about having an MVP and doing some market testing, making sure that you have product market fit. So how did they go about that?
So initially, Moove tested their business model in Lagos, Nigeria, focusing on providing revenue-based vehicle financing for mobility entrepreneurs. Basically what we have discussed, primarily on ride-hailing platforms such as Uber. So this approach enabled them to directly address the needs of individuals who could benefit from access of a vehicle for livelihood, but were unable to secure traditional financing. So in terms of, the testing is largely around revenue-based vehicle financing, basically looking at people who take these vehicles for purposes of making generating revenue on taxi hailing apps.
Awesome. So it sounds like these guys went back to, what they know, went back to Lagos. And they said, let's test this in the very place that we would want to roll this out, right? And that makes a lot of sense, because if they had tested this in the UK, right? Because they're British-born Nigerians, they could have tested this in the UK and said, let's do it in the UK, and then if it works here, let's go do it in Nigeria. But the thought process was, we're targeting people on the continent doing this type of thing, right? I mean, they could have tested the technology at the very least, in the UK, but they went to the very people that they know are going to be using the product, tested it with them. I'm sure they did some sort of alpha and beta testing and made sure that it actually worked for the people that they were targeting. And it sounds like they got good signals regarding that market fit.
Exactly.
And that's when now they started scaling this business out.
Yes, I think they got pretty good signals because, I mean, for a business founded in 2020 and this is 2024, and they raised capital in 2024. Although we will go into more details, they raised capital in 2024 at a valuation of $750 million US.
Wow.
It goes to show you the amount of growth as well as growth potential in the business. And having been formed only about 4 years ago, then it seems, of course, we the assumption is that they did their MVP, the alpha and beta testing and whatever testing they needed to do for their minimum viable product pretty well.
Yeah. Right.
So that goes to show, and we're basically reviewing this deal. If you've had the benefit of watching our previous episodes, from episode 1 to 8, you will be able to appreciate some of the items that we're discussing, because we did delve a bit into MVP,
testing,
minimum viable, exactly,
product market fit,
finding a market fit, and all that.
Awesome.
But we're hoping these concepts will settle better. Because we've picked a deal that goes through all these stages and the steps.
So go back and check out those episodes if you haven't.
Exactly.
Okay. So now we get to the funding, which I think this is a big part of what this episode is really about, because we're deconstructing the deal, right? How did they get the money in? What was the deal? So we'll start first with what happened before the big deal that happened
before
this year.
the fundraising that came in.
Exactly. So
from Uber, Uber is the lead investor. So we're sort of rolling the carpet, and where we are leading it to the more recent deal where Uber was the lead investor and invested, I think, $100 million US.
Correct.
Yeah, but please let us know the story behind that now, the build up.
Sounds good. So the funding. So we've spoken about in episode 8, we talked about the investors. Who are your investors? And we actually mentioned that probably the very first investor is yourself as a founder when you're bootstrapping. So these guys bootstrapped for a bit up until when they got to their seed round. Though even in their seed round, they were still investors in that round. So they raised $5.5 million in their seed round. That's in 2020. So pretty early on. The majority of that funding came from the founders themselves, as well as a gentleman named Iyinoluwa Aboyeji. He's a co-founder of Vandela and Flutterwave. So pretty high pedigree as well. Key partner at the company. He dubs himself a founding investor in the company. So pretty early on, you can see someone like that. That's an angel investor. Well, I would say he's called himself a founding investor, which is a new term for me. But he came in pretty early, right around the time with the founding team. Sounds like he's a good friend of the company or of the founders. And he believed in them. He had conviction in them, and he put his money where his mouth was. And so he was an angel. He was basically a very early, what I would think of as an angel investor, because he also co-founded Andela and Flutterwave. So presumably he made some exits there. And he has now he's now invested so early in this business. So you can imagine he invested at the seed stage. Today, we've talked about they have a $750 million valuation. Whatever his slice of this company is, whatever it was, has grown tremendously to the point it is now.
Of course.
Which again, I think is a plug for African high net worths to look at seed investments in startups, because this could have been you, right? If you had invested. I don't know how much he invested, but let's say $500,000 in this type of company, you could now be sort of reaping the rewards. You could be looking at such a huge valuation and you could be poised for a really cool exit.
Exactly.
So that's the seed stage. That was in 2020. Fast forward to August of 2021. They're now raising their Series A. And of course, we talked about seed stage, Series A. So you see these guys, they didn't really have a pre-seed raise to speak of. They didn't have a post-seed either, at least based on the information we've seen. So they skipped now to a Series A. So everything's really going well. There's good traction. Now let's really grow this thing. So they get to Series A. Series A was both equity and debt. So it was $23 million in equity, $23 million, and $40 million in debt. So the lead investors, and you alluded to this, lead investor being the primary people who are leading this round of investment. So if Tim and I were investing in a fitness app, and we're the lead investors, we're the people who are at the front of the queue. We're the ones who are usually dictating most of the terms. We're the ones leading the negotiations. And we may have other people that we know that we brought along because they were interested. There'll be co-investors with us.
Exactly.
But largely, we are the face of this investment round. We're the ones who are going to make the biggest press releases. We're the ones who are going to be the face of this deal, really, when it comes to the investment side. So it's really cool to have good lead investors who are fully aligned with you, who are going to see your vision out, and hopefully will also come in at future rounds, which we'll sort of talk about that. But the lead investors in this round were Speed Invest and Left Lane Capital, which are both VC funds. So we spoke about how VC funds tend to come in pretty early.
Exactly. Yeah.
So these are VC funds that found these guys at the Series A stage. So, I mean, they came in with other investors, a bunch of them. We won't list all of them, but they're mostly VC investors as well. So Verod, Keppel Africa Ventures, Palm Drive Capital, etc. They all come in for 23 million in aggregate. Again, 23 million then at that valuation compared to the valuation now, that's again going to be a huge sort of multiple in terms of what they've earned based on this investment. So that was Series A. The debt portion of that was $40 million. The lender was one of Moove's existing lenders, so I guess they're taking in some loans before that. So that their existing lender was EMSO Asset Management as well as IFC.
Yeah, they
so
got
IFC,
funding from IFC, and
that's huge, right? Getting investment from IFC, even if it's debt, but from one of the most renowned DFIs.
DFI, and we explained what a DFI is in
the previous episode.
In episode 8 when we discussed investors that invest in startups or businesses.
And as we said, we don't see DFIs always it's not
coming directly.
It's not the most common thing for them to come in directly at this stage. They rather, you usually see them in a VC, but the fact that they're getting direct exposure, even if it's in the form of debt, I think that's pretty interesting. The purpose of the Series A funding was to allow Moove to grow and expand into new markets, as well as to develop and launch new products. So we'll speak about that more, I think, when we get to a portion later on where we talk about how they've scaled across different markets and products.
Exactly.
So that was Series A. 6 months later, they did a debt financing, which is small, I guess, relatively speaking for them. $10 million in February 2022. There was a facility from NBK Capital Partners Mezzanine Fund 2. So that's a fund that's specifically, I think, doing just lending or credit investments. Purpose, again, was to sort of propel the expansion of Moove. This time specifically within West Africa, at least initially in West Africa, and then broaden. So we've gone through a seed stage. I mean, of course, they bootstrapped for a bit, but there's a seed stage there for about 5 odd million. There's a Series A for 63 million, equity debt split, a bit of debt financing. And then now we get to Series A2.
Exactly. And which goes back to a discussion that we had in episode 4 about the splits in fundraising cycles.
Correct.
So the traditional ones, you'll have maybe angel investment, pre-seed, seed, but then you can have seed 1, seed 2, seed 3, and now we have post-seed, and then you could have even Series A or Series B, but in between, and this is a very good example that they had Series A1, and then they moved to Series A2.
Right?
Yeah.
And we talked about the runway that you'd expect for this type of money. So by the time they raised Series A in August 2021, I think the expectation was from investors that this money should last you 12 to 18 months, right? So before you raise a Series B, before you give us a new valuation and you bring in new capital. For whatever reason, they get to 7 months in and they say we're going to raise a Series A2. So it's not a Series B, which is, I guess, if they had named it a Series B, that would also now complicate things. But now it's a Series A2. It's like an add-on to the Series A. Like we're just doing another round within the round. It's not a new round. The valuation, we don't know. As up until this Series A2, the valuation is not publicly available. So we don't know what the valuation was. If it changed at all from Series A versus Series A2. What we do know is that they raised $105 million in that Series A2. And that was equity debt split again, $65 million in equity, $40 million in debt. Now, interestingly, the lead investors in this round, again, Speed Invest and Left Lane Capital. And an additional one. They have a new lead investor as well, who is a new investor, first time coming in this round, which is the latest Dot Ventures. So we've spoken about the importance of your investors sort of doubling down and coming back in for a follow-on round. Yeah, and how important it's a good signal for other investors, right?
Exactly, it's a good signal for other investors. It shows that they are sold out in terms of the value, what you're proposing, and the idea itself.
Yeah,
And the fact that they are lead investors in the Series A2.
right.
Yeah,
I think that's key.
Yeah,
I think it would have been maybe odd if they were doing the A2 and the existing investors weren't coming in. Because then it's why are you raising again? And why are you raising from other people? Like, we're here, we brought the money in, give us more of a bigger slice in the company as we go. So I think that's a good signal all around. The purpose of the Series A2 was to provide even more funding to scale across the present markets and to move into new markets now outside Africa.
Yes.
So at this point, they've been scaling within the continent, but now they're also looking to cross into Asia, Middle East, and Europe over the following 6 months, the 6 months after, following from March 2022.
Yeah.
So I think also the big reason for this funding was to compete in these markets, because in those markets there are other competitors who are offering similar-ish products where it's financing with proprietary credit scoring for mobility entrepreneurs specifically.
Yeah.
So maybe going into new markets where your moat is not as strong, so maybe you need more funding to shore up your position in those markets.
Yeah.
Again, valuation was still not publicly available as of this time, but we assume it was, getting up there. Now we hit another funding round. This one is unnamed. They didn't really put a label on it. They didn't sort of label it as a Series A3 or anything like that. But we know
from the data we have.
Yes. Yeah. So internally, they might have other information on this, of course. But based on what we know, they raised another $76 million. This was announced in August 2023. This is 17 months after Series A2. So they could have called this a Series B, I think. But I think probably they knew that they had the Series B coming down the line in early the following year.
Yeah.
In 2024, which is Tim just going to speak on shortly. So this 76 million was $28 million in equity from new and existing investors, which again, very key that the existing investors came in again, as well as new investors led by Mubadala Investment Company. We spoke about Mubadala, yes. They are sovereign wealth fund. They don't typically, or sovereign wealth funds don't typically get exposure directly into startups, especially not this early on. But again, it sounds like a good signal. Existing investors are doubling down. They're seeing a good investment opportunity that probably can scale and can create really good returns. So Mubadala comes in together with other investors for $28 million in equity. There was $10 million in debt. This is from funds and accounts managed by BlackRock. Again, another huge institutional name. 38 million also in previously undisclosed funds that had been raised during the prior 12 months. So that was a part of that disclosure as well. So at this point now, we have the very first valuation that we know of, which is $550 million. So you can imagine at the seed stage when their founding investor came in 2020, whatever valuation that, I mean, of course, it's very hard to say what the value would have been then. Fast forward to August 2023, and they're looking at a $550 million valuation. The growth there is just amazing. It's just staggering. Yeah.
Especially when you look at it in terms of the valuation of the business, which equally applies to the value of your shareholding, your equity in the business.
So whatever slice you have of a $550 million valued company,
that's to be huge.
You came in and got 5% at the beginning. That's massive. You're laughing all the way to the bank.
Yeah. Well, when you exit.
Yes.
When you exit, you would be laughing all the way to the bank.
Upon exit, you're laughing all the way to the bank. Okay. So now that leads us to the deal, the eponymous deal that we are deconstructing today, which is the Series B deal, which happened earlier this year. You want to talk us through that?
Yeah. So earlier this year, they raised $100 million US dollars.
Okay.
In equity, in a deal that was led by Uber.
Okay.
So Uber as a lead investor, this had some strategic benefits to them, and we discussed this in our previous episode about what sometimes investors are looking. Sometimes it's their strategic fit, and for Uber, this made sense to invest in Moove because Uber operates in numerous cities across 8 African countries, being South Africa, Nigeria, Kenya, Egypt, Tanzania, Uganda, and the Ivory Coast. So since its services are largely available in major urban centers, there's a huge demand in those centers for, ride hailing services. So investing in Moove, a business that, and when you say actually Moove has expanded, when you look at Moove's expansion into countries, it's actually expanding into cities mostly.
Yes.
Yeah, the target investments into the cities where there would be a bigger need for, taxi hailing apps or such business ride hailing services. So for Uber, there has been, again, going to the strategic benefit of the transaction. For Uber, there has been challenges, with regulators or just market challenges in some of the jurisdictions. Some of them include disputes relating to commissions.
Yeah.
And I think in Kenya specifically, there was a time drivers were demonstrating, they were picketing, saying, they're not happy with how they're being paid, and questions around taxation and licensing.
I remember that quite well because I'd wake up and try to call an Uber to go to the office.
Yeah.
And there are no Ubers on the road.
No Ubers
because they're on strike. They're sort of trying
switched off their apps. Yeah.
But there would always be one person.
Of course.
And he'd pull up and be like, enter quickly.
Yeah,
sure
it's the hustle. Yeah.
Because he's afraid
the hustle
Uber
has to go on,
see.
Commercial decisions have to be made even when you're picketing,
Collective action is tough when not everyone is.
No, you still have to make commercial decisions, if you still have to pay for the car, you can't take the picketing too far,
Sorry to derail us, but so when you were working as a mobility entrepreneur at the time, were there any strikes or things like that happened, and were you informed? Like, how do you find out that, guys, tomorrow we all switch off our Uber, we're not taking rides until they increase our commission or our fares or reduce the commission or something?
So for me then, when I was doing that business, I actually didn't know many people who were doing it, like personally. Yeah, because I was working during the day, I would just, actually sometimes when I'm up very early, I would get trips to take people to the airport. So I'll take people to the airport in the morning and then drive to work and switch off my app and work the entire day. So in the evening when I'm leaving for going home, then I'll switch it on. Yeah. So I wasn't really that invested and to the point of knowing the community, knowing what people are complaining about. I was really a little shielded from that. But I'm sure if you're in the industry for long enough, you may even become the chairman of the lobby group, right?
So you're the guys who would still pick, then
when I did the business, I don't remember a time people picketed. I don't remember one that was massive, and if it was there, perhaps I sort of ignored it because I was perhaps doing other things, combining the business with So some of those challenges, of course, make it more strategically aligned for Uber, such as the disputes in some markets and the challenges in some markets, to partner up with Moove by investing in them as enablers of their business. So again, there's competition from the likes of ride-hailing apps like Bolt. So of course, the more footprint you have in terms of vehicles in a particular market, the more helpful it is for you.
Because this is a rider or a driver that's going to opt for Uber instead of Bolt, right? Because I can finance their acquisition of a car as opposed to maybe Bolt doesn't have a Moove equivalent, right?
Exactly. Okay. So it seems to suggest, of course, that there's a move for Uber to push to have a concerted effort towards having more vehicles within their line, because Moove plans to introduce about 45,000 new vehicles in the Uber platform. Okay. So that works both ways. Right. We have investment from you, we're growing, but at the same time, you're getting some vehicles.
And the people we're lending money have a way to make money, right?
Yes. And Mr. Delano, one of the founders, indicated that the investment by Uber is one of the validation of Moove's business.
Yeah.
The fact that Uber has come and led a round of investment that is 100 million USD.
Hmm.
That's of course a significant validation of Moove's business. The investment that Uber made in Moove was Uber's first investment in such business in the continent.
Okay.
Which goes back to the point that we are saying that it's a massive validation of the business that Moove is undertaking.
Yeah.
And perhaps equally of the strategic alignment between the parties. Yeah.
And it speaks volumes because
Yeah.
Uber's not in the business of investing, right?
Mhm.
That's not their primary
Exactly.
business model.
Mm.
But the fact that they've seen this company and they say there's huge strategic benefit to us to invest in this
in
company
this
early
business,
on.
exactly.
Again, yeah, I think it's a huge
Our
validation.
synergies are aligned.
Yeah.
Yeah. So
Awesome.
some of the other investors in this round, where they raised 100 million, included Mubadala. Again. Yeah.
So,
Yeah.
Very interesting. Again, that they're coming back
Exactly.
in. Good signals all around.
Mhm.
Your existing investors are coming back in. They're
Yeah.
doubling down. They're showing that they believe in the future.
Mm.
Amazing.
So yeah, and the investment was done at a valuation of 750 million USD.
Got you.
And I think
That's the post valuation. So after the deal,
yeah,
that's the
post
valuation
money,
now.
post money. It wasn't pre money. And when we say pre money, post money, is that the valuation of the business before the money you're raising comes into the business.
Correct.
Is this much?
Correct.
And post money is a valuation of the business after the money checks in, after you've closed the deal that the money has come in.
Exactly.
And it's a simple mathematics. If you're valued pre-money at 750 million and you raise 100 million, your pre-money valuation is 750 million.
Mm.
Post-money valuation is 750 million plus 100 million, which is 850 million.
Got you.
Yeah. So the valuation post-money was 750 million. Now, we equally have to point out that just after closing the equity fundraising round of 100 million led by Uber, they also raised $10 million US in debt.
Okay.
And the lender was Strive Ventures. Yeah.
Awesome.
So, yeah.
So a bit more debt as well.
A bit more debt. Yeah.
And what was the purpose for this Series B? So they've raised 110 million all in. What's that money going towards?
It's expansion, as Moove makes plans to expand its revenue-based vehicle financing to 16 markets by end of 2025. So they're planning to use the capital to expand to more markets, 16 more markets, to cumulatively 16 markets by end of 2025, which is by end of next year.
Wow.
Yeah.
That's amazing.
Yeah.
And I mean, of course, we were not there in the room when the deal happened, but based on our experience, we assume initially there was contact, people spoke. I mean, Uber already had a partnership with Moove, so probably that was a very easy conversation for those folks to have about, we're interested in coming in to invest. This is what we're thinking about. This is how we can continue to synergize and grow our relationship.
Yeah.
Now, not just as a partnership for you to onboard people onto Uber, but in terms of us actually investing and being on your cap table. So there's some sort of conversation. Probably there's a term sheet very early, what we're expecting. This is the general deal terms, subject to final documentation, subject to due diligence, all of that. We talked about term sheets generally and what's binding and what's not binding.
Yeah.
So at that point, if someone had written down $100 million on the term sheet signed by all the investors, it wouldn't be binding, but it's indicative of what they're looking to get to. Then there will, 100% there must have been a due diligence whereby people opened up Moove's books, looked at, board minutes, shareholder meetings, resolutions that have been passed. They look at, so especially in a business like this where it's so heavily reliant on the proprietary technology, there must have been a review of that intellectual property, like who owns that. We need to make sure it's owned by Moove and not by the two founders in their personal, in their individual capacities, right? Because otherwise they're the ones we should be investing in, not in the company.
Exactly.
So looking at the IP, looking at the current, who are the employees, what's the composition of the board. So there must have been a thorough due diligence by, the investors coming into this round.
Yeah.
But I think also they must have had some comfort knowing the investors who had come in earlier had done some sort of due diligence, that they had then come in subsequently in other rounds, that Mubadala, who had come in before, was coming in again. So once all that's done, there must have been some sort of documentation that they now agreed on for the actual entering into of this agreement.
Yeah.
So I'd imagine some sort of like subscription agreement, seeing as they're most likely creating new shares that they're then going to issue to Uber and Mubadala. And yeah, once people signed that deal, it was then, subject to if there were any closing conditions that needed to be satisfied, those were satisfied. And then they closed on the deal. And typically it's when you sign the deal is when it gets announced, because it's a huge deal. It's been confidential up until that point. And I didn't see anything about pending, regulatory approval or anything. So I'm assuming this was a simultaneous sign and close, or that it was pretty close in terms of like when signing happened and when closing happened.
That's the assumption. Yeah. From the data that we have, so it could be
different.
It could be different. Yeah.
So that's the deal, and then the deal happened. So now Uber and Mubadala own shares in Moove. They're now on the cap table. If you look at the cap table of Moove, you will see Uber Technologies, or however they go by, and whatever their percentage shareholding is, together with all the investors who came in earlier. Of course, there's also significant amount of debt that's held by the company as well, or that is owed by the company as well. So that was also, I guess, now added onto by that little $10 million that they added at the end. So all in, they've raised what now?
All in, they have raised $250 million in equity and $210 million in debt. So cumulatively, that's $460
million
raised.
That's
Fun fact,
that's
though,
crazy.
Yeah, fun fact. Moove alone attracted 24% of the funding in the continent in Q1 of the year.
So it's the biggest deal we've seen so far. Date of recording as of today.
4%. That's a significant chunk of the entire African continent.
Yeah. Can you imagine one? We look at all the deals that happened in the first quarter, and you are a quarter of all of that funding. So it just speaks to how huge of a deal this was.
Exactly, and the faith that you're getting, but equally you're getting the kind of the credibility of some of the investors.
Yeah.
IFC is giving debt. Badala is investing. Uber. I mean, some of these big names. BlackRock is involved.
Yeah.
It's really some serious validation into on your business.
So dreams can come true. Eh?
Dreams can come true.
These guys were sitting together
founders,
in 2020.
Yeah.
I don't think they could have imagined in their wildest dreams that 4 years later they would have a $750 million valued startup.
Yeah.
So yeah, it takes time, takes grit.
Exactly.
Takes good legal advice. Talk to your legal advisors. This is not legal advice.
It's not.
Talk to financial professionals. Talk to people who've done it before. Watch the Full Scale podcast. Maybe you'll learn something
or two.
And go out and take some chances.
Yeah, and we're really hoping that you're getting some value. Perhaps you want to tell us how they're scaling?
Yeah. So we've spoken about the idea, the formation, the founders, the funding, which is all mostly geared towards scaling the business. So how exactly are they scaling? What are they using this money for? So remember, they successfully launched and initially tested in Lagos. They then quickly expanded to several cities in Africa, as well as going beyond. So now I think you spoke about the countries within the continent, but now they're in markets in Europe and in the Middle East, because the idea has proved scalable. So remember, how do you know if your idea is scalable? Can you actually grow this and adapt the same model in many different jurisdictions across many different product lines, create new verticals, and reach so many different people all around the world? So, and create those sort of supercharged returns that we talked about. So the way they're doing that is geographically. So they're going to new markets. So they've gone outside of Africa. Now they're in the Middle East. They're in Europe. They're now also looking at different vehicle classes. So we spoke about Tugende doing motorbikes and how that's sort of a bit more niche.
Yeah.
They're now, Moove is now looking into buses and trucks as well. So I think if you think mobility, they've tackled the Uber hailing type of clientele. But now what about logistics? What about mass transit, instant delivery platforms, receiving your food, receiving parcels, packages, truck deliveries, that type of thing. I mean, if you've looked at the model and it's working within mobility entrepreneurs, perhaps you can then expand that to other people within that same space, outside of just the hailing sector. So they're looking at other categories, other market categories within that space, as well as also going geographically to other regions. I think they're also looking at new partnerships. So some of this is, journalistic speculation. So even the journalists don't have confirmation of this yet. They've just heard rumors. But the rumor is that Moove is also looking at other ride-hailing platforms that they could perhaps expand and partner with. So outside of an Uber, maybe they could have a partnership with Bolt or Little Ride, or whoever these other up and coming ride-hailing companies are, because it's a cool lead into that market. So we already have the riders. We just need the platform to put them on. We already have Uber, so maybe now they can go into Bolt and all these other platforms. So that's pretty much how they are currently expanding. I wouldn't be surprised to see Moove even on more continents soon, and in even more categories and sectors across the market.
Yeah, of course.
That's how they're scaling full scale.
Yeah, full scale. So that's an impressive story, and we hope to see more of that in the continent.
So where are they at now? So what's the current status of the company now that they're scaling? They received this funding. What are they at now?
So data as at last August, Moove had 15,000 customers. When we say customers, these are people acquiring vehicles.
Okay.
They had 15,000 customers, and that's huge. Because even when you look at data of how many cars, for example, let's say BMW sells of a particular model in Europe.
Yeah.
Some of these numbers are very attractive.
Right.
15,000 is a huge number for
especially if they're new cars.
New cars, exactly. If you look at how some of these vehicle companies sell a particular model, some would be very happy to sell 15,000 units.
Yeah, we played golf with a guy once who in the marketing automotive industry, and he was talking about how tough it is to move new units specifically.
New units,
on the continent.
I remember that conversation. Yeah,
that was
one
some
of the
mini wisdom from the golf we got
exactly.
from him.
That's mini wisdom. Yeah, he was mentioning the challenges, and I think some of these numbers are quite impressive. Now this
so that was August.
Customers, August have completed more than 22 million trips.
Okay,
going to show the revenue they've made. Now Moove facilitates more than 30 million trips for over 20,000 customers across its 6 markets. Now you can see the progression from August, 15,000 to 20,000 customers in 6 markets.
That's 5,000 customers acquired in just
about a few months.
That's amazing.
Yeah. Then Moove's annual recurring revenue also increased from $90 million to $115 million during this period, between August and I think about Feb.
Q1 basically.
Q1 of this year. So you can see the profit. And they're projecting to achieve profitability in the upcoming financial year. I think we can distinguish between revenue and profitability. So sometimes a startup can be revenue positive. That means it's generating revenue, but it has not yet hit profitability.
Okay.
Yeah. So so for Moove, despite the fact that they are making revenues of over 115 million, they are now projecting that they will achieve profitability in the upcoming financial year.
And just to continue on that point, being you're raising the revenue, of course, their revenue being people are repaying the loans that they took out in order to fully pay down the car. Yeah. And that's coming in at an interest rate. So that's creating revenues for them from these 20,000 odd customers. But even as that revenue is coming in, they still need to pay down things. They need to pay salaries for their employees within the company. They need to acquire these cars that they're going to then, sort of make these loans on the basis of. They need to fund research and development for their proprietary technology. There's all sorts of costs that they have for this business model. But once all those costs are paid, what's left now, right? That's when now we get into the profits. So they're still not yet profitable. And many... We were talking yesterday about how Uber wasn't profitable until like
for a long time. Yes.
Yeah, from being founded in 2009, I think, till 2023, no profits.
Yes.
So it's amazing that in 4 years they're about to become profitable. Though of course Uber's business model was a bit different and the things that they were looking at. But it's pretty cool that they've been revenue positive for a while and that they're now looking at potentially being profitable towards end of this year. towards the upcoming financial year.
Yeah, it's probably towards the end of 2025. I've not checked when their financial year and
because again, we don't know. Yeah.
Exactly, but they're projecting that they will have achieved profitability.
Okay.
Very soon.
Awesome.
Yeah, so they currently operate in 13 countries and 13 cities, across 6 markets. That is Nigeria, South Africa, Ghana, the UK, India, and the United Arab Emirates.
Wow.
So, and has approximately 360 employees.
Wow.
Yeah.
That's amazing. So they're creating value for their shareholders. They're creating jobs through employment for these 360 approximate employees.
Mm-hmm.
They're making a difference in the lives of these people who need the money in order to finance purchasing of vehicles so that they can provide rides.
Yeah.
They're providing rides for the people who need them, right? Because Tim quit. So someone needs to go out and do the job. Yes, I mean, I don't know. It's a cool company. It's a cool concept. It's very innovative. It's growing at scale really quickly.
Yeah.
And their early investors are really going to hopefully one day make a huge exit.
Hopefully.
Yeah. I mean, I think that's a good summary of Moove and Uber, specifically this deal, and the origins of it, all the way from conception of an idea all the way to where they are at now.
Yeah.
And I'm hoping in that conversation we've parsed out many of the issues that we've been talking about in our previous episodes, and that folks have been able to see how all of those things directly dovetail into what's happening in the real world.
Mm-hmm.
Yeah. Anything you want to add on that before we move into some fun segments?
Yeah, just to add that to what you've said, that really this is a case study that perhaps helps our audience understand the nuances of the movement of a startup, fundraising, scaling up, and going to different markets, testing your product in a particular market, expanding to other markets that may appreciate that particular product in a similar manner. We do hope that we will have much more success stories in the continent, and we wish Moove well. We hope they scale up and keep being profitable and keep growing in value. We are watching this space. Yeah.
So give us another deal maybe for Q. Well, maybe they'll need a little more time before they get to Series B2 or to Series C. But we'll be here and we'll take note and we'll talk to folks about it.
Yeah.
But that was the deal. We've deconstructed it, and now let's move on to some wisdom from the course. Tim, you want to give us some wisdom from the course?
Yes, this week's wisdom from the course comes from, I think I take it back to a golf trainer, a famous one called Harvey Pinnick.
Okay.
And Harvey was famous for one, and is famous for one statement: take dead aim.
Okay.
Which is basically when you're swinging or you're about to play your shot, you must always ensure that you have taken one last dead aim at your target where you want your ball to go. Now, how does this come down to actual instances when you're playing golf? The way you play, your eyes identify a target. Your eyes inform your brain what they have seen. Your brain informs your body, how it moves. Your body, including your hands, move the club, and the club hits the ball. Now, if the last thing you put in your mind was an obstacle, let's say there's water, maybe you're taking a shot that is you're teeing off, and that hole maybe to the pin is about, let's say, 170 yards, but in between there's water covering almost 100 yards, of the distance from the teeing spot to the hole. If you put water as the biggest thing in your mind that you're focusing on, means you're focusing on the obstacle as opposed to the shot. Your eyes will inform the brain of the importance of that water, the value that you've placed. If you were to draw a graph, your mind is giving the water prominence over the target. your eyes inform your mind informs your hands inform the club, and the club hits a ball into the water. So the lesson there is to always focus on what you're meant to achieve as opposed to the obstacles that are in between what you want to achieve. It's taking dead aim of your targets at the direction you're going, as opposed to taking time to address the obstacles. If you take dead aim, chances are you're going to have a good shot. If you're looking at the water hazard or the bunkers or trying to avoid a tree, chances are high you hit the tree. You ever tried to get out of the rough and you're seeing there's a space, but in your mind, you're trying to avoid hitting some tree.
Yep.
So what happens when you're trying to avoid hitting the tree? You actually get the tree square and your ball comes back to you.
That happens.
So it's a power of basically learning to focus on what you want to achieve and making sure that is the most filling thing in your mind. So that's the wisdom from the course.
Wow. That's really cool wisdom. Thank you for sharing that. And it's very true, because the times I don't think about my target last, that swing, even putting, especially, I saw something that said your mind can only really remember like the last 10 seconds of what you focused on. That's really what it grasps and really captures.
Yeah.
So when you're putting, I try as much as possible when I'm putting to look at that hole right before I go to hit the ball. Because if I looked at it 15-20 seconds ago and the rest of the time I've been trying to figure out my stance and power, by the time I hit it, I've already lost the target.
Exactly. You've lost the target, or you've even lost the depth, how far the target is. So you need is probably harder. You'll be too firm and it flies out of, probably into a bunker. Or you'll be too gentle and it doesn't go anywhere.
That's awesome. Yeah. Thank you for that awesome wisdom from the course.
Yeah.
Okay.
So you want to tell us something you learned that was interesting? I think this week we'll only have something interesting from the week from you.
Yeah, you don't have anything interesting?
I think my week has been very flat. But tell us, what has been interesting for you?
It's okay, you told us about your Uber stories, which for me were very interesting. Interesting thing for the week. This is something I heard on during an interview between Tim Ferriss. Tim Ferriss is the host of the Tim Ferriss podcast, one of the most successful podcasts in the world. And he was being interviewed by Sean Puri, who's another podcast host who I follow on many different socials. So anyway, Tim Ferriss shared this wisdom. He said, big dreams are easy to hide behind. And he explained it as such. When you have a big dream, let's say, I want to be the fastest rally driver, I want to be the best golf player in the world, I want to be the most successful person on the continent, whatever it is, or I want to make the biggest impact in people's lives and change the world. Those are big dreams, and they're easy to hide behind because they're so massive. And it's all well and good because you can tell your friends, your family, your people close to the founder that are happy for you, and they'll say, wow, that's really a cool goal. Like, wow, that's a huge dream. We wish you all the best. But when it comes to taking concrete steps towards that dream, it's really easy to say, wow, this thing is so big that I don't even know if I can do it, or maybe I'll start on it tomorrow, or I'll wait a week, or I'm not yet prepared enough and I'm not yet where I need to be in order to take that step. So big dreams are easy to hide behind. What's not easy to hide behind are the small concrete steps, the next step, the thing right in front of you that you can do, that you need to do in order to get to that eventual goal. So the best example he gave is himself. So Tim Ferriss, he has this huge worldwide podcast now, many, many episodes in. He started it. He didn't know if it would succeed or if he wanted to do it or all this. He said, I'm just going to do 6 episodes. It's going to be a mini series. If I like it, I'll continue. If I don't like it, I'll stop. So he broke it down into those concrete steps. I'm just going to do 6 episodes. If you can't do 6 episodes and you want to have the best podcast in the world, if you can't do those first 6, then probably you're not going to have the greatest podcast in the world because you didn't get there, right? That first step, that's pass fail. That's how he describes it. Either you do it or you don't. If you didn't do it, then you're not going to get to the other big one. If you do it, now you can contend for the next step. right? So breaking it down into those steps, even if you don't have all the 100 steps it takes to get to that place, just get the first one and do that one. If you do that one, you're well on your way. If you can't do that one, you're not going anywhere. So it was really cool. Cool piece of wisdom. It's big dreams are easy to hide behind, but small, concrete next steps, those are pass fail.
Wow.
Yeah.
Wow. I like that. The wisdom in that.
Yeah, right?
That's absolute wisdom. That's
Cool
an
guy.
interesting thing of the week, but full laden with very
Wisdom.
good wisdom. So yeah, thank you for that.
No
Yeah.
problem. No
Take
problem.
step one. Stop hiding behind.
Yes.
Big
even
dreams.
Us, even us, we did episode
Yeah.
1. We went out, we said, let's just do it.
Yes, and I remember how episode 1 was all over for us.
You know, but we did it, right?
We
It
did
was
it,
a
yeah, of
measurable
course.
step.
That was a goal. Like we had been speaking about it for so long.
Yeah.
It was time to do something. So
Yeah, action.
I'm glad we did. And yeah,
Do it scared.
do it scared.
Build in public. You know, we've been building this. I mean, we've not gone and produced all the episodes and
Yeah.
waited and sat on them and said
Edited.
maybe we'll. You
Yeah.
know, we went and did it and put episode 1 out. And
Exactly.
people are now saying, okay, every Tuesday we're expecting an episode.
Exactly.
So now you do it. You create that momentum. You just go do it.
Yeah.
So yeah, just do it.
Just do it.
Yeah.
Wonderful. So yeah, after that wisdom, do you want to wrap it up for us? I
Yeah,
mean,
sure.
yeah.
So thanks for joining us on this episode, this special episode 9.
Yep.
We're now officially 90% of the way there.
Yes.
Next
for
episode,
season 1.
For season 1. Next
Yeah.
episode will be our season finale
Yeah.
for season 1. But thank you for joining us this far. Episode 9, we've been talking about a specific case study. We've been deconstructing the deal. The deal being the 100 million equity investment led by Uber into Moove. And we've talked about Moove as a company, as a startup, their journey from idea stage, who the founders are, what they've done, how they're scaling, how they've funded this idea, and where they're at now. So hopefully it inspires you if you're out there and you have a startup idea. Look to these people, look to other startups out there, especially on the continent, and what they've been able to achieve. So yeah, that was the episode. Thank you for tuning in. Thank you for viewing. Thank you for listening. We are the Full Scale Podcast. You know where to find us. Don't forget to like, comment, share, subscribe, and we'll see you next week for the season 1 finale. Bye.
Bye.